from over here first. Okay, so I think we can get started with the training, if that's okay, since it's 7. So what we're gonna do is, there's a lot of resources on the Dutchess County Planning Federation, and there's a few good ones that we thought we might be able to utilize. They're longer, they're like an hour and a half, so we'll just do segments of it, like do first segment now and then the rest of it at the next meeting. But this one is on Housing Development Finance 101. It was done by Doug Alcott, who works for CPC, so he's financing a lot of the projects kind of in the Hudson Valley. Why we thought this was important for the board is I think when we're talking about design choices and we're talking about aspects that could be added to planning board projects, I think something we often heard is that's not financially feasible, or, you know, I think we hear that a lot, especially now in the current construction, in the financing climate, about how expensive these projects are and why or certain things can be added or cannot. So I think in order to have more fruitful conversations with applicants when we're talking about that we thought this finance course might be helpful. I haven't seen this one yet, but I heard good things about this, and Doug Alcott actually came and did a training for the city council last year, kind of on the same topic. So we'll run this until 7:30 is when the trainings go, right? And then we'll get into the meeting.
And I'm pleased to welcome our speaker, Doug Alcott with CPC, the Community Preservation Corporation. Doug has worked in a variety of roles with CPC for over 25 years, and he's currently the Senior Vice President and Director of Lending in their Hudson Valley office. He oversees the lending process from origination through underwriting, construction supervision, and conversion to permanent financing. And I'd just like to add that one of the reasons we wanted to host this class is that at county planning, we understand that when you're on a local planning board, you're reviewing a post-housing project, or you're not on board, but you hear about something in your community, it can be difficult to understand how the financing comes into play, and at what point the project may not be feasible anymore. So while every project is different, there's a balancing act in what pencils out with the bank and what doesn't. And so I expect that this presentation will provide us all with a more concrete understanding of the complexities of housing development and financing. So with that, I will turn things over to Doug.
Thank you, Ed. Good evening, everybody. Pleasure to be here. One thing that Ed didn't mention is, aside from my role here at CPC, I've also been a member of the Croton Zoning Board of Appeals, where I live in the village of Croton, Hudson, down in Westchester County for 16 years. So I'm familiar with these continuing education courses and have participated in that level. So I guess there's a way to say I'm one of you. I wanted to give you first a little background about CPC. We were established in 1974. We are a not-for-profit lending institution, which is kind of a weird model, but we have a consortium of about 15 banks that offer us lines of credit to do construction loans. Well, it's one line of credit. We loan it out on their line, and then we also have a number of permanent loan products for when the project gets completed and leased, and is mostly what we do is rental housing. We do some homeownership housing, but we also do the 30-year permanent mortgage on the project after it's completed. And we believe that housing is really central to transforming neighborhoods into thriving communities. We try to collaborate with municipalities, with not-for-profits, with private developers, with church organizations, all with the goal of trying to make our community better, provide both market rate and affordable housing, because we realize that there's different segments within the community in terms of affordability, and our goal is really broader community revitalization goals for the communities that we work. So that's a little background on us. Since 1974, we've invested over $14 billion. Almost all of that's been in New York State. We have regional offices throughout the state, as Heather mentioned, I'm the director of the Hudson Valley office. I've been for 28 years. And then there's just sort of the other benefits that go into the investments. We've financed over 225,000 residential units, which provided housing for more than 1 million people, and also creates jobs. We estimate 120,000 jobs created through our programs. So that's sort of like the social benefit. And then we're mission driven, so we're not really a bank. We don't do we don't do luxury housing. We don't do hotels. We focus on housing. We also do mixed use properties, which involve typically ground floor retail, commercial businesses. But mostly our focus is on housing, and we're trying to figure out ways to lower the cost of producing affordable housing, and help close the racial wealth gap, and also commit to invest in the green economy. A lot of what we do is we have a whole sustainability department. We try to promote green building, energy efficient buildings, and so that's also one of our kind of mission goals. So that's about us. And then before I get into the program, I kind of wanted to just give you like what I want the takeaways to be here. And some of the things some of the slides are showing involve math. I don't really don't get too tied up in math. I'm really just illustratives to show how a lender looks at a project and a developer, and the due diligence that we do before we agree to finance a project, how we monitor it throughout the construction, how we also monitor it once it goes into a 30-year permanent mortgage. We also service all of the permanent loans that we do. They're typically 30-year mortgages on multifamily rental properties that we finance. So we also monitor post construction and lease-up as well. And I think that sometimes people think developers are just running amok in the streets and doing whatever they want, but there's a lot of oversight that goes into lending on an affordable or any kind of multifamily project. It's a very risky, there's a lot of risks involved with it, and we take it very seriously. So, we're typically investing usually somewhere around 75 or 80% of the total project cost. So we're the biggest investor in these projects, and we take it very seriously, and we want to make sure that it's successful for the developer, for the community, for the tenants, and for the developer. So those are the takeaways that I want to try to imprint in your mind before I get going in the presentation. So the first thing I wanted to talk about is what we call the 5 C's of credit. And these are the things that we look at when we're looking at a developer or a particular project. And the most important C is character. And so we're reviewing the credit history and experience of the borrower. We check their business references, we check their credit references. We Google them. We want to make sure that they're reputable people, and that they're going to provide, that they're going to perform on a project when we finance it. We look at their capacity. That's their ability to pay the loan. Previous projects completed. We want them to have done projects of similar size, similar scope. We look at their personal and business financial statements of both the developer and the general contractor for construction projects. We review the sources of capital. That's the third C. And that there's basically 3 types of capital sources. One is equity, or the cash contribution of the developer. And when I say CDC, I'm also meaning any kind of conventional or bank loan. We're a little bit different than a bank, as I explained, but most lenders will look at things the same way as us. And then if there's a gap, which there often is in affordable housing projects, because the rents are typically lower than in a market rate project, then we look to use public subsidy sources to fill that gap. So there's 3 capital sources: cash, conventional loan and public subsidy. And the fourth C is the collateral, which is the property itself, or if it's new construction, we're looking at the projected completed product, or what is planned to be constructed. If it's a renovation project, same thing. What was the project going to look like after it's renovated? We do a lot of adaptive reuse projects where we're converting old mill buildings into housing, or things like that. We call that adaptive reuse. And then the other collateral that we take on property is not just the property itself, but we want to ensure completion of the project. So often we'll take either a bond or a letter of credit as additional collateral. That's usually 10% of the construction cost. So if there's a cost overrun, then we can pull on a letter of credit or a bond to make sure that the project gets successfully completed. And then the last C is just what we call conditions, and that's like the condition of the neighborhood, what's going on in the market with construction costs, what's going on with the local economy, what's going on with the national economy, what's going on with interest rates, what's going on with market rents. So it's sort of like the conditions of the economy. And so those are the 5 C's of credit. That's what is the basis of our evaluation. And the next thing I wanted to talk about was the project feasibility. And there's 3 things that we look at in the pre-development stage before a project gets financed. And that is the site itself, or the project itself, the development team, and the financials. And that's, and I'm going to talk mostly about the financials of rental properties, because that's primarily what we finance. So the site itself, we go out, we inspect the property, we look at the site, we review it for, does it have zoning compliance, does it have access to transportation, are there comparable projects in the area, what are other municipal considerations, permits, building codes that need to be met, and are there any community plans out there, preferences, what does the community itself want? And we try to work with municipalities that want to promote different types of projects. So we look at that whole package when we're looking at a site or project. And then in terms of the development team, it's who's going to be responsible for making sure this is a successful development. And we look at the owner and developer and any partners. Oftentimes there's not-for-profit sponsors that go into joint ventures with different types of developers. We look at the experience of the architect and the engineer that's working on the project. We want to know about the general contractor who's building it, what's his capability. And then on the back end, we review the management company to make sure they're reputable. And the management company is subject to our approval prior to closing on a 30-year permanent mortgage. And then there's other consultants involved. There's a lot of programs out there, both through the utility companies and through the different state programs to promote energy efficiency. So there's also consultants involved that may be involved with that aspect of it. And then the last thing, and this is something I'm going to kind of focus on in the next few slides, is the financials of rental properties and how do you determine how much you're going to be loaned on the property. And unlike, most of you probably have your home buyer mortgages. When they qualify for home buyer mortgage, they're really looking at your personal income, which is different than multifamily lending. Multifamily lending, we're loaning on the cash flow of the building or the projected cash flow of the building. So when we size the loan, we look at the income from the apartments, retail if there is a mixed use, and other types of income that a property can produce, such as if there's a laundry room, if there's parking fees, or maybe cell tower rentals on the room. So we look at all the income that the property produces first, and then we look at the property operating and maintenance expenses. And those are what we call O&M. And that's basically all the property expenses exclusive of the debt service or the mortgage payments on the loan. And so, you can see the list of operating expenses, you've got your real estate taxes, insurance, utilities, repairs, management expenses, administrative and legal, you've got salaries, you've got landscaping, snow plowing, cleaning, snow. And $250 per apartment per year, which is paid monthly, along with your principal and interest payments, that goes into a savings account for the building. So that 10 years from now, when the building gets a new roof, we have a little nest egg to make sure that it gets maintained in the long term. So that's income and expenses. So we subtract the income from the expenses, and then we get what's called the net operating income, or some people call it NOI. Right? And that, the NOI, is what's left over to pay the debt service payments or the mortgage payments, and the remainder becomes profit for the developer, or cash flow. Or it could become, or it's a cushion in the event that something happens. So operating expenses go up, rents drop, things happen. It's a cushion for the lender as well as potential profit for the developer if things go wrong. So typically we take the gross potential income. So we take all the rents that they collect monthly. We subtract the vacancy loss of somewhere between 5 and 10%. And that's just because, apartments turn over, stores close, sometimes tenants don't pay rent, so it's a subtraction. You typically don't get 100% of your rental income per year because of vacancy or what we call bad debt or non-payment of rent. So I'm going to use a real life example. This is a real project that we did in East End of Newburgh. These young guys who actually came up from Brooklyn and decided to make their home in Newburgh, and they started buying small properties in the East End and renovating them into housing. And I changed the address here to protect the innocent, but suffice to say this is a real project in East End of Newburgh. And it was a vacant building, and it was able to be renovated into 5 apartments and 1 storefront. And then I'm showing the income here. The rents were just shy of $1,200 a month for the apartment. That was the average rent. There was a store that was paying $1,000 a month for their lease. And then, so that gave us a gross income here of $71,000 on the residential rents and $12,000 on the retail rents. But then we had to subtract the vacancy from that. So we had about a $5,000 allowance for the residential and about $1,200 for the retail space. So the net income goes down from $82,000 to $77,000. So that's what we're projecting is going to collect, hopefully. But what happens if one tenant here, one of these 5 stops paying rent for 6 months? And you have to evict them, and that takes another few months. All of a sudden, you don't have 7% vacancy allowance, you probably have more like 20%. So there's a risk of that. But generally, properties operate in these kind of vacancy levels. So we know what our net effective income is. This is what we're collecting, $77,000. But what are the expenses? Okay, so we got all our taxes, insurance, and everything else. So we got $38,000 in operating expenses, and we have a net effective income after vacancy of $77,000, total operating expenses of $38,000, and that gives us a net operating income to pay debt service and profit of $39,000. So how do we size the loan based on that? So that's $39,000 net operating income. We calculated that we could loan $440,000 on this property over 30 years at 5.25%. And so the debt service, principal and interest payments on that are $29,000. So this, roughly $10,000 is its cash flow and profit for the year, hopefully, if all goes well. So that the margins can be pretty thin on these properties, particularly small ones. And a lot of the Hudson Valley properties are in small buildings. And I don't need to tell you guys that in Dutchess County. There's a lot of properties that are, let's say, less than 20 apartments. That makes up the majority of the housing stock in Hudson Valley. So we look at something. So how do we arrive at this $440,000? We have something called debt service coverage. And the debt service coverage is the ratio of the net operating income over the annual debt service. So in this case, it's 1.34%. And somebody told me a long time ago, which made sense to me, that means for every dollar of debt that the owner has to pay, he has $1.20 to $1. Most lenders require a ratio of between 1.2 and 1.3. That means I have an extra 20 or 30 cents per dollar of debt in my pocket. And this is this 20 or 30 cents, or in this case 34 cents, is basically going to be hopefully as a profit. And that's how we determine the loan amount. So, remember that 440, it's a key number. The other thing we look at is loan to value. Okay, lenders do not like to loan 100% of the value of a property. Why? Something goes wrong, we have to sell it in a foreclosure, we have to foreclose on it. Typically, people in a foreclosure sale don't pay the full value of the property, they try to get it for less. So generally, lenders want to keep their maximum loan to value, known as LTV, of between 70 and 80%. So in going back to our example of 123 Main Street, we take the net operating income, how we determine the value, and we divide it by what's called a cap rate. Don't worry about what a cap rate is. That could be a whole other class. But it's basically an expected return that real estate developers expect in a particular market. In the Hudson Valley, cap rates generally range between 6 and 8%. So in this case, we use the appraiser uses 7% cap rate. We got a value of $557,000. That means our loan to value was $79,000. So we're within our range of 79 and 8%. So we have our debt service coverage of 1.3 or better, and we have our loan to value, which doesn't exceed 8%. It's a little bit less than 8%. That's how we determine this 440. Remember 440. Okay, so how does debt service coverage and loan value affect project feasibility? As I said, that's one of the things we're going to talk about today. And they affect the feasibility because they limit the amount that a developer can borrow for a particular project. If a developer can't borrow enough money, the project may not be financially feasible. And remember our sources of capital. We have equity, we have debt, and we have subsidy. We already went over that, so I won't go into that. And then you have development costs. For a project, you have what's called acquisition, construction, which is also known as the hard costs, and then you have what we call soft costs. And these are all your professional fees. You got to pay your architect, your engineer, the appraiser, the title company, the surveyor. I didn't put lawyer. That's a big number. And then you have your carrying costs. Like, what is it? I still have to pay before this thing gets built. I still have to pay real estate taxes on the land. I got to have insurance to cover the property and liability. I have to pay utilities because I'm using power tools at the site, and I have construction interest. When we do a construction loan, it's kind of like a credit card for a developer. He draws down the construction as the project progresses, and we advance it for work that's in place. So he has that to carry during the construction. He's not getting rent yet because it's not built, so that's out of pocket. He's got to pay for that. So those are the development costs. And so here's the real life example. These are real numbers. The guys, the Brooklyn hipsters that came up and decided to live in the East End of Newburgh, they paid $105,000 for the building. The construction costs of $300,000 and professional fees, carrying costs. So the total cost of this development is a little more than $500,000. We were able to loan $440,000. And so he had to put in $115,000. And that makes sense. That's sort of like the sweet spot for debt and equity, somewhere around 20% equity. Developers generally don't want to put in more than 30% equity. And here at CPC,
Sorry.
I've also been,
Pause there because we're at 7:30, so we'll pick up with the debt service coverage. I think. But yeah, I don't know if we want to chat about that or we want to move straight into the.
Anybody, any questions, comments? Party started.
Right.